Welcome to Alternative Investing. I'm Mark Bunting, along with my co-host, David Kaufman, president of Westcourt Capital. Now, this is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. In the past few weeks, we've looked at alternative investment products and strategies. This week, we'll look at the rules and regulations that investors and advisors must know to protect themselves and their investments. Now, David, we talk a lot about compliance, but what does that exactly mean?
Generally speaking, what compliance means is the adherence to certain rules and regulations that are set out to govern the way that people conduct their behavior in professional financial matters. And these rules and regulations emanate from a number of sources. We have provincial legislation. We have regulations from securities commissions. We still have securities commissions in every province, at least for now. And then we also have SROs, or self-regulating organizations, such as the CFA or CAIA, which also organize how it is that their members behave. And really what happens is that these rules and regulations are split up into three areas. We have products, we have financial firms, and we have people. So we have investment advisors. And if we look first at products, in order for a financial product to be sold to the public, its construction has to comply with whatever legislation applies to that product. And really, the world of financial products is split into two areas. On one side, we have prospectus-based product. That would be publicly traded vehicles, and the best examples would be things like ETFs or mutual funds, where there is a many hundred-page prospectus that, of course, we all read before we invest.
Of course, yeah.
And then these things are publicly traded, and that falls in one category. The other category are exempt products, exempt market products, which almost always are sold through the issuance of an offering memorandum, being the governing document for that. And that's really where what we talk about with the strategies that we talk about on this show, that when we have things like hedge fund partnerships, limited partnerships, other kinds of exempt product, this is the sort of product that falls in the exempt world and has to follow the rules of the exempt market. Then we turn from the products to the firms themselves. And so depending on what services the firms provide to investors, they are subject to a litany of different legislation and other regulations. And so again, on one hand, we have the banks in a very big picture way. And then we have others like mutual fund dealers, portfolio managers, investment fund managers, and exempt market dealers. And again, with the kind of product that we're talking about on this show, it's the investment fund dealers, portfolio managers, and EMDs that we would be talking to and about. And then you have, of course, right down, we have the individuals, the actual financial professionals.
Right.
And anybody that is involved in the sales process or in the provision of advisory services will work at a firm that is itself registered, and then those individuals will also be registered. And I want to point out that not only will they be registered and subject to that legislation and regulation, but if they're a charter member of, say, the CFA or the Chartered Alternative Investment Analyst designation, they're also subject to a whole host of other rules that their charter mandates, mostly to do with various ethics rules.
David, as always, a great table setter. And we'll take a short break here, but coming up, we'll be joined by a compliance pro who will tell us what your investment advisor needs to know about adhering to the rules. Welcome back to Alternative Investing. I'm here with David Kaufman, as always, the president of Westcourt Capital. Now, this week, the topic is compliance, both for you as an investor and for your financial advisor. This show will outline what you both need to know about different investing rules and regulations. First up, we're joined by Ellen Bessner, partner with CASSLES, Brock & Blackwell, and author of Advisor at Risk. She's here to discuss how advisors can be compliant and protect themselves in the course of business. There's a look at the book, and we'll let me throw it up here one more time. Nice to see you, Ellen.
Thank you.
All right, here's the book as well, in real life form. Now, you wrote this book a couple of years ago. Why did you write it, and who should really read it?
Well, I wrote it because I'm a litigation lawyer. I represent advisors in regulatory and in civil actions when clients complain. And it's a very bad day for advisors when they learn that there's a client complaint. It's very stressful, it's very upsetting, and it really shakes their confidence. And they turn to me as their lawyer and they ask me, can you make this go away? And really at that point, it's too late. If they had understood and known their responsibilities and their obligations in advance and identified the red flags, they may have been able to ward it off before the actual client complaint was delivered. But at this point, I have to break the news to them that this is a bit of a long process. It could go on for months and sometimes years. And it is, shakes their confidence in respect of their business. It can affect their personal life. And really, you feel bad for these people who just didn't see the train coming. So I started to write articles, and I published them nationally in newspapers and in publications for advisors. And it basically was the backbone of the beginning of a business that I started, which is presentation work and writing for advisors so that I can explain to them their risks and their responsibilities and how to identify the red flags before the actual train hits. So that was why I wrote the book. I kind of pulled it all together so that they'd have something, a resource, because there really isn't anything, either in Canada or the United States, that specifically explains to advisors what are the dangers in their business. How do they protect themselves? And so who should read the book? Really, advisors the branch managers, the advisors who are selling mutual funds, exempt products, stocks, bonds, the branch managers, the assistants for the advisors, because, you know, they work in teams, and the assistants, licensed or not, should really understand how to help the team function in a way that promotes compliance and helps them manage their risk.
So now that we know why you wrote the book and whom it's for, let's try and learn right now what it is that what we can learn from the book. And I want to start with the whole concept of Know Your Client, KYC.
Backbone.
Anybody that's opened an account with any registered dealer fills out a stack of forms, sign here, sign here, sign here, sign here, fill this out, fill this out. And can you describe to us the purpose of the KYC form and whether it works in practice and what it is that advisors should be thinking about while they're filling these documents out?
Thank you. That's a great question. So here we go. I mean, unfortunately, I can speak for probably a long time on this, but I'll try and give you just kind of a quick overview, which is KYCs are actually misunderstood. They are thought of as a form. And the concept is, I complete the form, the advisor believes, I complete the form and I'm done, I know my client. And that's just simply not going to cut it. Because really what their obligation is to know their client. And filling out a simple form doesn't get them there. So they need to do two things. First of all, they need to get to know their clients in reality, and the form isn't going to do it. And secondly, they need to protect themselves. And what do I mean by that? What I mean by that is for each question on the form, there's probably a good 10 other questions they need to ask. The KYC form is merely a summary. It's merely a summary of what they learned about the client. So in an hour meeting, they're going to have presumably a number of pages of handwriting or typing or taping or however they want to document it. And then from there, they synthesize that and they put it into a KYC form.
So if a client shows up and says, I'm ready to go, I've read all about this investment, here we go, I filled out my KYC, let's do it, not so fast?
Well, it's not the client's obligation to fill out the form. It's the advisor's obligation to know the client, and the form is merely a summary and evidence of having done that, so that then they can open the account with the dealer, and then the dealer's compliance department can compare what's in the form, the summary, and what's in the account, and match them up and say it's suitable or it's not suitable, and raise the red flag if it's not.
Anything else you want to add on Know Your Client? Because after that, you've got to know your product too, right?
You do. You have to. Well, it's a whole system, right? So let's talk about Know Your Product. Know Your Product is a relatively new concept compared to the Know Your Client obligation. Know Your Product has become a focal point of the regulators. They want to know, do you, as the advisor, understand what you're selling? It's not enough in the good old days for an advisor to just simply know the marketing materials, right? They'd know the marketing materials, they know basically what the bonding agencies have said, the rating agencies have said, And then away they go, right? They don't understand the risk of the product. They don't understand the underlying security. They don't know who the management is.
And let's drill down on that part a little bit more, because in the exempt market, which is what we deal with on this show by and large, we have relatively complex product, we have private product, and a liquid product. So once you're in, you're kind of in. And so during that Know Your Product segment, what is it that the advisor can do in the exempt market? Do they have to actually go and meet the managers and really understand everything about the product?
Well, they need to understand as much as possible about the product. It's, the reasonable rule. They need to know more than just what's in the marketing materials. They need to understand the underlying product sufficiently that they can explain the actual product and make sure that they are comfortable with the management. They've done enough research. They know enough about who's managing the product. They may not have to actually shake the hand of the guy, but not a bad idea. They need to get a comfort level that the product is real and that the management is real and that it's a fundamentally sound product.
So I'm the advisor, I know my client, I know my product, and now we have the third leg, which is really, is it suitable? So once I know, what I'm selling and to whom I'm selling it, you have to put those things together. And can you talk about suitability? I also know that we have a board right out of your book to talk about the suitability triangle, but this is extremely key, is it not, in the relationship?
It is fundamentally key because it is at the heart of most lawsuits. Right? So like, I don't know, 90% of lawsuits hit on the issue of suitability. And the client alleges that the product is unsuitable. And so the question is, what is suitability? And if you look at it superficially, it's actually really easy to understand what suitability is. It's matching the risk tolerance of the client with the risk of the product, right? And then fundamentally choosing a group of products for the client so that their portfolio is sufficiently diversified, because suitability is not just about the one product, it's about the diversification. Here's where it gets complicated, because to explain it as simple, here's where it gets complicated. We've got 3 balls that are in the air all the time that are changing. And this makes an advisor's job very difficult, whether you're selling an exempt product or whether you're selling a product that's not an exempt product, because the client's changing every day. Right? Even just to get older by one day. I know that sounds depressing, but the volatility of the market, the actual market is changing all the time. And we've suffered from that recently. And the difficulty is that clients come to the advisors thinking that they're going to make the money, not lose the money, and that they have somehow a crystal ball so that they can project into the future and know for sure that the product is going to be a good product for them to invest in. So you've got the market going up and down all the time, and then you've got the actual underlying security. What's happening with management? What's happening with that product? How is it changing? Is it changing in a way that's making it more risky, less risky? Is it doing well? Is it not doing well? And the advisor has to keep his or her eye on each of those moving balls all the time.
Oh, I got to go reread the book.
All right. Thanks so much for your time today, Ellen. Thanks for the insight.
My pleasure. Thank you.
Here's the free plug again. Advisor at Risk. It's a national bestseller by Ellen Bessner. Thanks again to her. Stay with us. We'll be back to tell you, the investor, what you need to know about compliance. Jonathan Heymann, president of Witchcrest Compliance, will be joining us.
Kaufman is one of Canada's leading experts on alternative investing. He's the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital, and we're joined now by Jonathan Heymann, president of Witchcrest Compliance. He's here to tell us how investors can best protect themselves before they part with their cash and if something goes wrong. Nice to see you, Jonathan.
Hi, nice to meet you.
Now, you have your own firm, as I mentioned there off the top, but you have quite a history with compliance. And I guess the best place to maybe explain that past is you were at the Ontario Securities Commission for a long time.
Well, exactly. I mean, in my current role, I do assist firms that are registered with the various securities commissions, both in order to get registered with the commissions, and then on an ongoing basis, I assist them in their compliance and registration needs from there. But before that, I used to be at the Ontario Securities Commission, and I spent a fair amount of time in the OSC Contact Center, where we used to receive calls from investors all the time regarding their investments, and a lot of them used to be elderly investors who had called us up not realizing and not understanding where their money had gone. And I think the most important thing that investors have to do is to do some research right at the beginning, contact their local regulator, because every individual who is advising or trading in a security does need to be registered in the province in which their clients are. So they need to contact the regulator there, find out if the individual as well as their firm is registered, and beyond that, what category of registration they have, which dictates exactly what types of products they're able to provide to investors.
So that's amazing. We know that a lot of people spend longer buying a car than they do picking an advisor or choosing a suitable investment. So it's that easy, right? That you can start by saying, at a bare minimum, I want to establish that this person is registered at all in my jurisdiction. I'm the investor where I live. I want to know that they're registered. I want to know what they're registered as. And I guess that simply having looked at those two things, in some cases, would avoid investors getting involved with unscrupulous characters.
Absolutely. And nowadays, the commissions do publish a list on their website which details the scams that they've encountered. And they have an advisory list which recommends to investors who they shouldn't be dealing with because they're not complying and they aren't registered with the various commissions. So the most important thing is to start with your regulator. No one's going to care about your money as much as you do. So it's up to you to do some research.
Well, let's get one thing straight right off the top here. The fact that someone is registered does not mean that the OSC or whatever securities body it is approves of them, right? It just means that they have technically met the requirements?
Exactly. It means that they have met the basic requirements in order to be registered to sell a specific product. Following that, of course, it's up to the firms and the individuals at those firms to know the product, like Ellen was saying before, and to educate themselves and to be able to impart that information to potential investors.
So, Jonathan, let's say an investor has made an investment and then he or she discovers that they think it's unsuitable for them. Where do they turn after that?
Well, depending on the category of registration of the individual that they're dealing with will dictate whether they need to talk to either perhaps the MFDA, IROC, or directly with the securities regulator. So, for example, if a firm's registered as an exempt market dealer, then they would deal directly with the Securities Commission. And that's a starting out point, to perhaps use them as a sounding board to get information from them as to whether they have something to go on.
In some cases, of course, the investors aren't sure, which bundle of alphabet letters they're involved with. If they start by calling, for example, the Securities Commission in the province in which they're located, would that person, it used to be you answering the phone, say, okay, let's start at the beginning and figure out what category you're in?
Absolutely. I mean, they are there to help, and they're there to impart information and explain to investors the types of products that are out there, who's eligible to sell them, and what sort of information they should be looking for.
And of course, because we have the internet, this doesn't have to be done by telephone. I know that we have a list here that you've provided us of where investors can turn to on the internet to get started, right? To understand whom we see it here on the screen.
Exactly, and I suggest putting up the Securities Administrator website. The CSA is a grouping of all the individual provincial commissions, and that's a good starting out point because they have links to all of the other regulators. And in addition to that, they have an investor education section, and they also have further information about the types of things that investors can educate themselves on to know what types of questions they should be asking of the representative before they invest.
And what are we looking at, the difference here between IROC and MFDA?
Well, IROC regulates investment dealers. The Mutual Fund Dealers Association regulates mutual fund dealers, of course. So they should be, if you're dealing with someone from one of those categories, then that's who you could be contacting as well.
But not to get too complicated, but you could buy mutual funds through an IROC dealer.
Well, that is true. So it's more specific to that.
So that can get a little bit confusing there.
Jonathan, Ellen talked about suitability from an advisor standpoint. Let's talk about it from the client standpoint. What does a client or investor need to know in terms of what's a suitable investment for them?
Well, I think they have to look at where they are in life, where they want to go to, and what types of products would be suitable. So it's all about asking the right questions. It's all about talking to different brokers, different representatives, and seeing what types of products they are advising on. But ultimately, it is the investor who will make the final decision as to whether it's right for them to hand over their money. So they really do have to do a lot of research on their own.
And how much, when you used to accept calls from the public, you mentioned off the top that a lot of them were elderly people.
Yes.
I suppose that the concept of illiquidity and age come together quite quickly if someone decides that they're in something bad?
Very much so. And not all products are suitable for all investors. So if it doesn't look suitable to you, then perhaps it's not the right thing for you to get into.
What are the trends you're seeing right now, Jonathan? Are investors becoming more knowledgeable? Are there problems out there? How do you see that?
Well, I would say there's certain sectors of society that are getting more knowledgeable. I think there's still an awful lot of people out there who are all too willing to hand over their investment decisions to someone else, because quite simply it's easier to do that. But nowadays there is so much information out there. If you do take the time, you will not regret it later.
And speaking of knowledge, we often talk on this show about the concept of accredited investors, or people that use the $150,000 exemption. They put it all into one security, which makes them de facto exempt. Have you seen, in your experience, any specific link between annual income, net worth, financial assets, or $150,000 in one investment, and the amount of knowledge that that investor has?
Absolutely not. I mean, you can have someone who's a truck driver who reads the papers and understands exactly what's going in the market, and then you can have a dentist who's earning over $300,000 a year but has absolutely no clue about what investments they should be in. So there's absolutely no correlation at all.
So the fact that they might technically be allowed to buy it doesn't mean necessarily that they should get involved.
That is correct.
Okay, now I'm also interested in knowing, you've been on both sides of the aisle. You know, before you were at the OSC, and now you're helping dealers get registered, stay registered. In doing what you do now, what do you draw on from what you learned when you were on the other side to help you do what you do now better?
Well, I think now, and the OSC and the various regulators have used the term of a culture of compliance. And I think that's the basic starting out point for dealers, if that's how they want to operate ethically. They have to understand the products they're working for, that they're promoting. They also have to understand the investors and where they're coming from. So I think it's everyone understanding what they need to be doing in order to protect the investor.
Thanks very much for coming in today, Jonathan, and shedding some light on this topic.
You're very welcome.
Jonathan Heymann from Witchcrest Compliance. Nice to see you, David.
Nice to be here as always.
See you next week. That's all the time we have for today's show. If you've got a question about alternative investments, email us at alternativeinvesting@bnn.ca. Thanks for watching. We will see you next time.